All right, welcome back. Today, we are diving into a paper that really, truly changed how we think about economics in the developing world. So picture this. It's 1994, and an economist, Robert M. Townsend, takes one of the most elegant ideas in all of economic theory, this concept of perfect insurance, and he decides to test it. But not in a lab, not on a stock market. No, he goes to three of the poorest, most high-risk villages you can imagine in southern India. This was just a groundbreaking use of real-world data to ask a really profound question about survival and community.
Okay, so let's start with the question that's at the heart of this entire study. Just imagine for a second that you're a farmer. Your crops fail, but your neighbors, they do great. Do you starve, or does your community somehow step in? I mean, this is not some theoretical puzzle for millions of people. It's a question of life and death. And the deeper issue that Townsend was getting at is this. In places where there are no formal insurance companies, do these informal networks, family, friends, local lenders, do they actually step up and fill that gap? And maybe the most important question of all, how well do they actually work? So here's our plan for today. We're going to start by setting the scene in these Indian villages. Then we'll unpack this really powerful idea called full insurance. After that, we'll see exactly how Townsend designed this clever test to see if that idea actually holds up in the real world. Then, of course, comes the verdict, which, let me tell you, is way more interesting than a simple yes or no. And finally, we'll look at why this one single paper basically sparked a revolution in its field. First things first, let's understand the world we're talking about. The villages in the study, they're in the semi-arid tropics of India. Life here is, to put it mildly, a constant gamble. We're talking about incredibly low per capita income and agriculture that is completely at the mercy of these erratic monsoon rains. And on top of that, you've got crop failures and human diseases as a constant threat. It's an incredibly high-risk environment where just one single stroke of bad luck could be absolutely catastrophic for a family. So how do people cope? Well, they do it through something economists call informal risk sharing. And this isn't some single institution. It's more like a web of community relationships. Think about it. Gifts between family members, transfers of food among friends, maybe flexible loans from the village lender who might let you miss a payment in a bad year. Economists knew this stuff existed, of course, but before this paper, the whole discussion was mostly qualitative. Nobody had ever rigorously tested just how effective this web of relationships really was. And that right there brings us to the intellectual backdrop. See, at the time, the default assumption in development economics was that markets in places like these were incomplete, which is just a fancy way of saying things like formal insurance didn't exist. But that was almost a throwaway line. The really crucial question was, how incomplete are they? I mean, do these informal arrangements work so well that it's as if a formal insurance market is right there? Or do they fail, just leaving families totally exposed to every little shock? That is the question Townsend set out to answer. To even begin to answer that question, he needed a benchmark, right? A yardstick to measure reality against. And for that, he turned to one of the most powerful ideas in economics, the theory of full insurance, or what we sometimes call complete markets.
Okay, this is so cool because it boils down a really complex idea into something super simple. So, without any insurance, what you eat depends entirely on what you grow. If your harvest fails, you eat less. It's that simple. But with full insurance, it's a totally different ballgame. The best way to think about it is like a village-wide pot of grain. Everybody puts their harvest into the pot, and then each family takes out what they need to eat. All of a sudden, your family's consumption is no longer tied to your harvest, but to the size of the total village harvest. Your own personal ups and downs get smoothed out by the community.
And this lays out the beautiful, clean logic that makes the whole theory testable. It's a simple progression. If all the income is pooled and everyone is drawing from that same pool, then an individual family's consumption should only really go up or down if the entire village's pool of resources goes up or down. And this leads us to the key testable prediction. Your own personal income shocks, your specific crop failing, your ox getting sick, should have zero impact on how much you consume once we've accounted for the overall economic health of the village.
So that's the sharp prediction. How in the world did Townsend actually test it? Well, he took it from the abstract world of theory to the very real world, using incredibly detailed data from three specific villages: Arepale, Shirapur, and Kanzara.
And this is it, the paper that won the Frisch Medal. For his test, Townsend got his hands on an absolute treasure trove of data from the International Crops Research Institute for the Semi-Arid Tropics, or ICRIC. I mean, they had tracked dozens of households in these villages for years, recording everything from income and crop yields to exactly what they ate. It was the perfect data set to put this big theory to the test. Okay, now for the test to work, he had to separate two different kinds of risk. First, you've got aggregate shocks. Think of a massive drought that hits the entire village. The theory predicts this will affect everyone's consumption because that total pot of grain gets smaller for everybody. But then you have idiosyncratic shocks. These are the things that are unique to you. Your ox gets sick, but your neighbor's is perfectly fine. A localized pest hits your field, but not the one down the road. This distinction right here is the key to the entire empirical strategy.
So this is the test, stated as simply as possible. Townsend's method basically says this. Let's look at all the households within one village in 1 year. They all face the same big picture conditions, the same monsoon, the same prices. So if we control for the average consumption in the village, which captures all those big aggregate shocks, does a family that had an unusually good income that year also have an unusually high consumption? If full insurance holds, the answer has to be no.
So, what did he find? Did this elegant theory actually hold up in the messy reality of village life? Well, the answer was not what you might expect.
The top-line result was crystal clear. Statistically, the model of perfect full insurance was rejected. A household's individual income shocks did have a statistically significant effect on its consumption, so reality did not match the perfect theoretical ideal.
But, and this is a big but, if we just stopped there, we'd miss the entire point. That rejection was just the beginning of a much, much more interesting story.
This quote, straight from the paper's abstract, captures the true discovery. Yeah, the model was technically rejected, but as a benchmark for understanding what was actually happening, it worked surprisingly well. The real story wasn't about failure. It was about the remarkable degree of partial success. So let's break down what he actually found. The data showed a ton of consumption smoothing was really happening. A family's consumption moved way more closely with the village average than it did with its own super volatile income. Those personal idiosyncratic shocks, they still mattered, but their effect was drastically reduced. So the big takeaway is that these villages provided partial insurance. The informal markets weren't perfect, not by a long shot, but they weren't absent either. They were doing a lot of the work. And the data also revealed that this insurance wasn't shared equally. Landless households, for instance, seemed a lot more vulnerable to shocks.
And this nuanced finding, combined with the way Townsend actually reached it, is what sparked a full-blown methodological revolution in the field of development economics. Now, this is where it gets really interesting. Before this paper, if you wanted to ask a big-picture question like how well do markets work, you'd probably use theory, or maybe some aggregate national data. This paper showed that you could use detailed household data, microdata, to test these massive general equilibrium questions. It basically provided a template, and it launched an entire field of research using rich panel data from villages to study everything from credit markets to microfinance.
And you can trace its legacy so clearly over the decades. In the 90s, it just kicked off this wave of studies on consumption smoothing. By the 2000s, its ideas were directly shaping how economists were evaluating the real-world impact of microfinance programs. Now, it's basically a foundational text for anyone building these complex structural models of village economies. It remains an absolute cornerstone of the field today.
And ultimately, I think this is the paper's most enduring message. It demonstrated that economic theory isn't just some abstract exercise for rich countries. It makes sharp, testable predictions absolutely everywhere. It proved that with the right data and a clever research design, you can go into some of the most complex and challenging environments on Earth and measure, with precision, how close reality comes to our theoretical ideals. And in doing so, you can reveal a world that is far more economically sophisticated than we ever imagined.